I'm Max Keiser, and this is the Keiser Report. I'm here in London, where the bankers are demanding their year-end bonuses, and the government is asking them, please, Mr. Banker, don't steal any more of our money. And the bankers are saying, wait a minute, if we can't steal your money, we might leave. And the government is saying, no, we want you to stay and steal our money. Meanwhile, the IMF is asking people in Ireland to suffer more austerity, while the IMF is redecorating its lush headquarters in Washington, D.C. Yes, the banking scandals continue. Let's bring in Stacy Herbert.
I'm here at Heathrow in a little back office at Heathrow, trapped, waiting for the 1 centimeter of snow to clear. So I just want to bring up, you're at the heart of it all. I'm kind of at the heart of it all. I'm at Heathrow, you're in London. And I want to say, it's where Julian Assange, of course, has been let out of prison in the last week. And I want to call attention to this tweet of his. Does your business do business with Bank of America? Our advice is to place your funds somewhere safe.
Oh, Stacy, I love this tweet. And I love this Julian Assange. He's basically doing to the bankers what the bankers are doing to us. The bankers put a gun to our head and say, give us all your money or we're going to blow ourselves up and everyone around us. Now, Julian Assange has figured out that he can return the favor and tweet Bank of America and say, look, if you no longer accept payments on behalf of those trying to send me a few bucks, we're going to shut you down. That's the way it should be. The people who should be shutting down the banks, they are terrorists.
Well, you might want to call our show Keiser Leaks, because there was, in the most recent cables, U.S. Embassy cables, Mervyn King says in March 2008, bailout fund needed. So this is Monday, March 17th, 2008. And Max, you and I happened to be at the Bundesbank that very day. And in this cable, Mervyn King sent a memo saying bank in crisis, now one of solvency, not liquidity. So King, at the time, who is obviously the head of the Bank of England, suggested that the US, UK, Switzerland, and perhaps Japan might form a temporary new group to jointly develop an effort to bring together sources of capital to recapitalize all major banks.
That's right. Insolvency, not illiquidity. What does this mean? It means going back to 2008 when Hank Paulson went in front of Congress and said, give us some money to cover our bills for a few months because we are illiquid. He was lying. He did not tell the Congress that the banks are insolvent. Had he been truthful, then Congress would have shut down the insolvent banks and they would have created some new banks that were not run by freaking financial terrorists like Goldman Sachs and JP Morgan. He lied. Now, Mervyn King told the truth, but of course that information did not get into the public domain. It's globalization for the bankers when it's convenient for the bankers, but everyone else, of course, does not benefit from having globalized information, except for WikiLeaks and Julian Assange. That's why he's so dangerous by those who want to keep the system as it is by siloing information and accessible only for the most corrupt of the kleptocracy in the US, the UK, and around the world.
The other thing that is important in this cable that was leaked is that Mervyn King told these U.S. Embassy officials that it was, quote, imperative to find a way for banks to sell off unwanted illiquid securities, including mortgage-backed securities, without resorting to sales at distressed valuations. King said sales at distressed values only serve to lower the floor to which banks must mark down their assets, in parentheses, mark to market, thereby forcing unwarranted additional write-downs. So here they're saying that they don't want capitalism. They themselves, you see this command and control action in action.
Right. Well, this is the key, isn't it? In other words, the real estate market in America became securitized. That is to say, all the mortgages that were fraudulently sold to these poor people all over the world, particularly in America, were packaged up and resold in the wholesale market. And then when the real estate market started to collapse, instead of having the securitized mortgage also collapse, those securitized mortgage pools were kept at 100 cents on the dollar. And for 3 years, they've been playing hot potato with hundreds of trillions of dollars worth of bad debt. No bank willing to admit that it's sitting on huge losses. And they keep going to the central government, central banks, and asking for more cash because they say it's a liquidity issue, when in fact it's an insolvency issue. The governments, of course, have run out of money, so they're imposing austerity onto the general population. Greece, Ireland, all over Europe. Soon in the UK, of course, huge austerity measures. Soon to be in the US. Why? Because the banks refuse to admit that they're sitting on toxic loans that aren't worth even 2 cents on the dollar. That's what needs to happen. It's not happening, and no leadership in America. Obama's not doing anything about this. No one's doing anything about this, and that's the tragedy, is that all the money that they spent to bail out the banks has only gone to feed the banker bonuses and has done nothing to resolve the problem. These debts are still on the balance sheet, and by my sources, there are still 20 trillion in bad debts yet to be disclosed. That's on a total global GDP of roughly 50 trillion. Imagine that, another 20 trillion in bad debt yet to be disclosed.
Aside from the fact that, as you mentioned, the debtors in society had to mark down their mortgages, their home prices by huge amounts, up to 50% in some parts of America, those who actually save have also been penalized massively by the likes of Mervyn King because interest rates were slashed. So here's a headline that is in the news in the UK. Investors told, forget savings accounts, think of shares. So Britain's 38 million savers have been urged to invest their money in the stock market after being warned that for many of them it is now a waste of time putting their cash into a savings account.
This is propaganda that is created by the City of London and Wall Street and other investment banks around the world, and they're getting away with it. In other words, to suck in hundreds of billions of dollars of fresh cash to bail out more losing positions, they are allowed to go out onto the public airwaves and encourage people to move money into the stock market, while at the same moment the ratio of insiders selling to buying is at a record high. There are something like 80 to 100 insiders selling stock for every insider that's buying stock. What are they doing at the same time? Encouraging the public, again, not disclosing this information in a meaningful way, to rush into the stock market. They will, of course, lose their shirt again, like they did in the housing bust, the dot-com bust, and all the other crashes that they've engineered for the past 10 years as part of their scheme to defraud the world, because they're frickin' financial terrorists.
Over in Bangladesh, we see a possible future for what it will look like in Britain should the 38 million savers in Britain listen to these so-called experts on the Telegraph and take out their savings and put it into the market. Bangladesh investors riot over stock market fall. So you see this picture here of Bangladeshis burning stuff outside the stock exchange, and the caption under the photo reads, "Ordinary Bangladeshis have been tempted into the stock market by higher returns than banks." So the stock market on Sunday fell by 6.7%, and investors were very angry because ordinary people were being paid very low interest rates at the banks on their savings, and they all went into the market. The prices on the stock market rose by 80% this year, and now they're all being wiped out. The people they said that sold were the institutional investors, the big investors.
That's right. Central banks lowered rates down to zero to help bankers, simultaneously penalizing pensioners and savers who are then getting zero on their returns. They're again shifting all the burden and the risk that the bankers incurred onto the balance sheet and the households of the people who had nothing to do with creating those risks. Now, the Bangladeshis are out in the street rioting because they were sucked into another scam and the market's crashing. We'll see the same thing in the U.S. and markets around the world because all this hot money coming into the markets now is being met with a wall of supply by the insiders who are going elsewhere with their cash and getting out of these stocks. It's remarkable. It's propaganda. CNBC in America, for example, they have this guy, James Cramer, who stomps up and down, encouraging people to buy stocks. He is basically the propaganda minister for Wall Street, and he should be outlawed, in my opinion.
Well, Max, actually, speaking of what the insiders and the smart money is doing, there is a headline in which, again, you factor in this campaign of the crash JP Morgan buys silver. Headline reads, JP Morgan caves and unwinds massive controversial silver position. So the story reads, the bank's outsized role in the commodity market was controversial, and it seems the bank has caved. It told the Financial Times that it has meaningfully reduced its role in the market and that its new position was, quote unquote, materially smaller, though whether that position is net short or neutral is unclear. The bank says the decision was purely the result of it wanting to reduce controversy.
Yeah, Stacy, this is the second exchange this year we've crashed. Remember earlier on the air on this show, Keiser Report, we exposed the fraud behind Cantor Exchange and Cantor Fitzgerald. They shut it down. They fired everybody, went home. Now we're going after JP Morgan, a bigger fish in the Wall Street pond. We're going to take them down. We're going through it. Julian Assange, we're with you, buddy. Solidarity, my man. We're going to take him down. What else you got?
This final headline kind of blends those two campaigns together, the one against the box office futures contracts and JP Morgan and their control and stranglehold over the fiat debt-based currency system, led by Ben Bernanke and the central bank. Could the WikiLeaks scandal lead to new virtual currency? So, as we talked about at the top of the show, Julian Assange has been cut off from this debt-based system. You have without access to credit, without access to your debit cards, to your your actual credit card. If you don't have one of those cards that people will accept, you're cut off from the whole financial system. So, as WikiLeaks has been, they're being attacked by the various banks around the world. So one solution is Bitcoin, and this is it differs because there's no central bank or other kind of controlling interest. It's entirely decentralized. Bitcoins are transferred between individuals or businesses by specifying their Bitcoin address, and then transactions are conducted through a peer-to-peer network. So there's no single point of weakness, and nobody can stop the Bitcoin system or censor it short of turning off the entire internet.
Yeah. That's fantastic. You got to have both the digital currencies, P2P network, take on the banks while simultaneously loading the boat with silver. Stacy Herbert, thanks so much for bringing on the Keiser Report.
Thank you, Max.
When we come back, I'm going to be talking with Mike Maloney over there at goldsilver.com, all about the trends in silver, so don't go away. Hi, welcome back to the Keiser Report. Time now to go to sunny Los Angeles and talk with Mike Maloney of goldsilver.com. Mike is the author of Rich Dad's Guide to Investing in Gold and Silver, and he has been traveling the world making some fantastic videos about gold and silver. You can find them all at goldsilver.com. Mike Maloney, welcome to the Keiser Report.
Glad to be here, Max. How you doing?
Fantastic. Now, Mike Maloney, I've just been watching your video, Dead Cat Bounce. Bernanke is dumber than gold, which I guess is a play on the phrase richer than God. And then there's Bernanke, he's dumber than gold. Yeah, you believe we are just entering into a quote-unquote true deflation. Talk to me about this.
Well, I wrote in my book, I started writing that in 2005 and I finished in 2007. And what I said was we were going to get the threat of deflation, followed by a bunch of bailouts and currency creation by the Fed, which they did. Then we would have real deflation, meaning a contraction of the currency supply. And that is happening. There's some private companies that reproduce M3, which the Fed hid from us in March of 2006. But these companies reproduce it, and I believe they are quite accurate. And it shows a $1 trillion collapse of the U.S. currency supply, and that's about 10%. It's almost 10%. The markets in the U.S. are way overvalued. They're back into a bubble. The PE ratios for the S&P are over 20. That's bubble territory. When you look at dividend yields are about 1.9%. That is lower, meaning it's a bigger bubble, than the first 118 years of data from Robert Shiller of Yale University. He constructed the S&P going all the way back to 1880. And there is no time from 1880 to 1998 where dividend yields were lower than this, meaning a bigger bubble in the stock market. And one thing I have observed is that since the year 2000, all of the stock markets have started to become linked together. They all are in lockstep with whatever direction the U.S. stock market is going. And so as the U.S. stock market goes down, it should drag the rest of the world with it. We should see deflation, followed by governments around the world panicking. And I do believe that they will print us into a hyperinflation.
All right, let's talk about this word deflation for a second, because people associate deflation and the collapse in money supply, as you point out, with a rising dollar and a paper currency like the dollar having an increase in purchasing power, as we saw in the 1930s. Of course, in the 1930s, the U.S. was on a gold standard. The U.S. is no longer on a gold standard. So am I correct to presume that lacking the gold standard, the deflation, the contraction in the money supply, and the response, which is to print lots of money, will have this inflationary or hyperinflationary effect? But what accounts for the lag time exactly between the contraction of the money supply, the printing of the money, and its eventual hyperinflationary collapse?
Well, what is responsible for the lag time is the fact that the portion of the currency supply that governments produce is very, very inefficient. The major portion of the currency supply in the United States, for instance, 85% of all the dollars created are created through fractional reserve lending. So it's the public borrowing currency into existence. And it's very efficient because it goes right into real estate, into business, into purchases people are making with their credit cards. When the public pulls back and they get frightened, they stop their borrowing and spending, the currency supply starts to collapse. If the government decides to do a bunch of treasury purchases, for instance, to create currency, where the Federal Reserve, a private corporation, is buying U.S. treasuries, which indebts the public in the future to a private corporation. It's a crazy world. But if they do that, it takes quite a while to filter through the government to get out into all of these spending projects, and you lose all of this energy as it goes through the different government offices and the bureaucracies. So it takes many, many times more currency produced to have the same effect that the public gets when they borrow currency into existence. So that is responsible for the lag time. But in the last deflation, gold rose from $20 an ounce roughly to $35 an ounce. And that really was the will of the public and the free markets doing this, because it was a change in exchange rates. And then once they unpegged the dollar from gold, the dollar's value fell from 1/20th of an ounce of gold down to 1/35th. So it was really the dollar changing. The rest of the world was using gold, so it wasn't gold changing. It was exchange rates around the world figuring out that the dollar wasn't worth as much. The gold actually rose in the deflation, so even though the dollar gained in purchasing power by 50%, gold magnified that by another 70%. It's doing the same thing today. Gold is basically just fundamentally undervalued. It doesn't purchase enough stuff. I don't care about gold's price. What I care about is how many shares of stock does it purchase, and how much real estate does gold purchase at the time. And right now, it doesn't purchase enough. It is re-exerting itself, and it's going to purchase more stuff in the future. So even if the dollar gains in purchasing power temporarily. Gold will magnify that gain. I believe that if we went into a deflation and stayed there, you'd still see gold up at $3,000 an ounce, and you'd see the Dow down at like 1,500 points. So gold would be double the points of the Dow.
All right, Mike Maloney, you have been all over the world shooting videos, talking to people in the gold industry and banking industry. Talk to me a little bit about China. I see China is just at this time launching a new exchange-traded fund. They're encouraging people in China to buy gold and silver. What's happening in the China story right now in gold?
The Chinese have always been attracted to gold. It is part of their culture. What's off the radar still there is silver. And when they start coming into silver, you are going to see an explosion that is nuclear. It'll be unlike any financial asset the world has ever seen. Silver is a very, very small market, and word is getting around. It isn't just China. China is going to make a big, big difference. One of the things that I have been teaching on my travels is that the last bull market in the 70s of precious metals was only North America and Western Europe participating, and it was a very small percentage of the population. This time, it is the entire world. If you look at the USSR, they couldn't buy gold, and they didn't have an exchange that helped set the price of gold. The spot price was set on the London Metals Exchange and the Commodities Exchange in the US. Those are the only two places where the spot price of gold was set. Today, it's set by exchanges all over the world. Everybody can buy. There's not enough of it. There's not enough silver. The whole thing is going nuclear. It's going to be huge.
Now, China has come out publicly and said that they need to increase their gold reserves by 3, 4, maybe 5,000 tons to try to catch up to the U.S. They've been stealthily buying gold for the last few years. They've raised their reserves in gold up pretty sharply. But now they've said we've got to buy a few thousand tons. Is this really... how are they going to do this without moving the price substantially, or is it just all bets are off and it's a mad scramble at this point for gold?
Yeah, if they do what they're saying, then you're going to see the price double, quadruple, or more than that, unless there's another government secretly supplying them. Now, if you talk with GATA, they have a lot of evidence that the United States and some other central banks have been selling gold into the markets. China could acquire, if the U.S. wants to keep the price of gold down, and China has that demand, I don't know. But the only way that China could accumulate without causing the price to just absolutely explode would be for another huge holder of gold to let it go without it hitting the markets, to be a private transaction, basically.
Yeah, well, no country has that supply of gold outside of the U.S. Germany has 3,000 tons or so, but most of that's held in New York, and then the list gets smaller from there. I want to move on for a second to Ben Bernanke, for the Federal Reserve Chairman. He was on 60 Minutes TV show recently. He made the statement that he understands he's flooding the system with lots of fiat money, but if need to, he can simply, within 15 minutes, start raising rates and reverse the damage and drain the system. Is that really plausible or possible?
Well, he can raise the Fed funds rates, but if there's a whole bunch of currency out there, base money is what it's called, that he creates. If there's too much of that out there and too much of it on the bank's balance sheets, you could see fractional reserve lending. Like I said, the major portion of the currency supply is not created by Ben Bernanke. It's created by fractional reserve lending when the banks create loans for houses, for cars, when you sign a credit card receipt. And so if the public gains confidence again and they feel good and there's too much base money out there, you could literally see a hyperinflation with the printing presses turned off. Ben Bernanke has influence over the bank's interest rates. He does not have control over them. He influences them through something called open market operations.
Right, and I guess if you listen to folks like Jim Rickards over there at Omnis, he'll point out that the money that is in the system is spread out over multiple maturity dates. So yeah, in the short term, he might have an effect, but you can't really go down into the maturity yield curve, I guess you could say, and totally reshape it based on his will.
He's dumber than gold. They're all dumber than gold. They think that they can control the free markets. All they can do is temporarily manipulate. And when they manipulate, energy builds up and the free markets eventually overwhelm the manipulation. And this is the reason we're going to be seeing far, far higher gold prices. We're going to be seeing increased deficit spending in the future. It's not going to be decreased. This monetary system that we've got now, its days are numbered.
All right, Mike Maloney, thanks so much for being on the Keiser Report.
Thank you.
All righty, and Mike Maloney's site is goldsilver.com. Check it out. He's got a lot of information and videos linked to that site. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Mike Maloney. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.